Most people believe that owning a little bit of crypto is just a harmless bet, a modern-day lottery ticket with asymmetric upside. So they throw a few $100s at Dogecoin, buy some Ethereum on a whim, and call it diversification. But here's what you haven't been told. The difference between a harmless 1% gamble and a portfolio-wrecking 10% bet is not just mathematical, it's the difference between walking away with a profit and becoming part of the statistic. In 2025 alone, over 160,000 traders were wiped out in a single day, with nearly $19 billion in leveraged crypto positions liquidated in October. The question isn't, should you own crypto? The question is, how much can you own without gambling your entire financial future? If you stay until the end of this video, you'll learn exactly what the world's largest asset managers, BlackRock, Schwab, and Fidelity, are telling their wealthiest clients about crypto allocation. You'll see the data on volatility, correlation, and risk-adjusted returns. And you'll get a simple, rule-based framework to decide whether Bitcoin or Ethereum deserves to sit in your portfolio and at what percentage. By the time we're done, you'll know whether you're an investor or a gambler. My name is your name, and today we're putting the crypto question to rest. Let me start with a story that will ground everything I'm about to say. In October 2025, a day now known as Crypto Black Friday, the entire cryptocurrency market was sent into a tailspin. A routine geopolitical headline triggered a cascade of liquidations. Over $19 billion in leveraged crypto positions were wiped out in a single day, nearly 10 times the worst day during the FTX collapse. Total crypto market capitalization fell by about 30%, from a record $4.2 trillion to under $3 trillion. Bitcoin plunged roughly 32% from its peak above $126,000 to below $85,000 in just weeks. Over 1.6 million accounts were liquidated that month. The people who lost the most? Those who had bet too much, leveraged too high, or treated crypto as a get-rich-quick scheme rather than a small satellite holding. One of them was a friend of mine. Let's call him Mike. Mike was 38, had a solid job, a 401(k), and a decent handle on his finances. In 2021, he put $5,000 into Bitcoin, about 1% of his net worth at the time. That was smart. But as Bitcoin rallied to nearly $70,000, then $126,000 in 2025, he got greedy. He increased his allocation to nearly 15%. He opened a margin account and started trading leveraged futures. By the end of 2025, after the crash, his $70,000 crypto position had imploded to under $15,000. He didn't just lose the gains, he lost a significant portion of his original capital. Mike learned the hard way that crypto allocation isn't about finding the next 10x. It's about size discipline. And that's what this video is about. The volatility reality. Why even a small bet can feel huge. Let me put the risk of crypto into numbers that will stick with you. The traditional 60-40 portfolio of stocks and bonds has an annualized volatility of around 8–10% in a normal market. Bitcoin, by contrast, has had annualized volatility of 72.1% over recent years, with a maximum drawdown from a peak of 73.4%. For Ethereum, those numbers are even more staggering: 98.3% annualized volatility and an 87.8% maximum drawdown. That's not investing, that's riding a roller coaster without a seatbelt. But here's where it gets interesting. Using data through October 2025, Schwab modeled how much Bitcoin or Ether could be added to a portfolio while capping crypto's share of total portfolio volatility at 5%, 10%, or 15%. A conservative portfolio would need only a 1. 2% Bitcoin allocation, or a 0.9% Ether allocation to reach a 10% crypto risk contribution. At 15% risk contribution, the Bitcoin allocation rises to just 4%, and Ether only to 2.9%. Even with an aggressive 15% expected annual return assumption, Schwab's framework suggests crypto allocations ranging from 1% to just under 9%, depending entirely on the investor's risk tolerance. The key takeaway is clear: even a modest 1 to 3% crypto allocation can carry meaningful portfolio risk. Going beyond 5% pushes you into a zone where crypto starts driving portfolio behavior rather than complementing it. The diversification case, low correlation isn't no correlation. Asterisk, one of the main arguments for adding crypto to a portfolio is diversification, and the data does show some diversification benefit. BlackRock's analysis found that Bitcoin's correlation to the S&P 500 stood at 0.53 from 2022 through early 2026, while gold's correlation was just 0.19. That means Bitcoin still moves somewhat with stocks. When stocks crash, Bitcoin often crashes too, though not always by the same amount. In the 2025 downturn, both stocks and crypto fell, but crypto fell significantly more. The caveat is that Bitcoin's correlation is not static. It has been trending downward as the asset matures, but during extreme market stress, correlations tend to spike toward 1. Gold's correlation to Bitcoin, by the way, is only 0.10, meaning the two assets have moved relatively independently. That's why BlackRock suggests pairing gold and Bitcoin as complementary diversifiers. But here's the bigger story from their May 2026 report. Bonds have become less reliable diversifiers for stocks since 2020, with correlations between stocks and bonds rising significantly. That means traditional portfolio construction is changing, and alternative assets like crypto and gold may be playing a larger role. However, BlackRock's recommended allocation for multi-asset investors remains just 1% to 2% Bitcoin, cautioning that higher allocations could sharply increase portfolio risk. Fidelity Digital Assets reached a similar conclusion in their 2025 research. They found that moving from a 0% Bitcoin allocation to even 1% can be among the most beneficial portfolio adjustments an investor can make, boosting annual returns by approximately 2% while increasing the portfolio's maximum drawdown by only about 0.5%. However, they warn that Bitcoin's risk does not scale linearly with allocation, it accelerates. According to their analysis, replacing 1% of a 60-40 portfolio with Bitcoin contributed roughly 7% of total portfolio volatility, whereas a 5% allocation contributed a much larger 17.8%. The first 1% gives you most of the diversification benefit with minimal additional risk. Every percentage point beyond that adds outsized risk relative to the benefit. The big question: should you own crypto at all? Given the volatility, the drawdowns, and the uncertainty, you might be asking, why own crypto at all? It's a fair question. The bull case for Bitcoin rests on a few core pillars. First, its capped supply of 21 million coins positions it as a potential digital store of value, akin to gold, but with programmatic scarcity. As central banks continue to print money and global debt rises, the argument for a non-sovereign, decentralized asset becomes more compelling. Second, the institutional landscape has transformed. In 2025 and 2026, major banks and wealth managers have moved from the sidelines into active guidance. Vanguard and Bank of America have approved crypto products for their clients. BlackRock and Fidelity now offer spot Bitcoin ETFs with hundreds of billions in combined assets under management. Third, the digital gold narrative remains powerful. Advocates point to Bitcoin's consistent long-term returns. It's been the top-performing asset class in 11 of the past 15 years. But here's the bear case that no one talks about enough. Despite massive institutional adoption, Bitcoin ended 2025 down about 6% for the year, roughly 30% below its October peak, above $126,000. It delivered a negative calendar year despite unprecedented policy and regulatory progress, while gold finished the year more than 60% higher. Bitcoin's performance has been increasingly driven by ETF flows, corporate treasuries, and speculative leverage, not the organic demand from true believers. The asset is heavily influenced by liquidity conditions, macro policy, and sentiment. Moreover, the crash of 2025 demonstrated that even with institutional involvement, crypto remains vulnerable to cascading liquidations and sharp drawdowns. The market saw over $1.3 trillion in market value evaporate, and while no major platform collapsed the way FTX did, the losses were real and painful. My verdict? For the vast majority of long-term, buy-and-hold investors, a small allocation to Bitcoin, and only Bitcoin, can be a reasonable satellite holding. Ethereum has too much technological and competitive uncertainty to hold the same store value conviction, and anything beyond the top two coins is gambling, not investing. The framework: how much crypto should you actually own? Let me give you a concrete framework based on the research I've just laid out. This is not random opinion. It's synthesized from BlackRock, Schwab, Fidelity, and Bank of America. First, consider your risk tolerance. If you're within 10 years of retirement, limit your total crypto exposure to 1–2% of your portfolio. You don't have enough time to recover from a 70% drawdown. If you're in your 20s or 30s and have a long time horizon, you might consider up to 4–5%, but no more. The key is to think of crypto as a venture capital allocation, money you can afford to lose entirely. Ask yourself, if Bitcoin dropped 80% tomorrow and never recovered, would you be okay? If the answer is no, your allocation is too high. Second, use a tiered approach. Bank of America's Private Client Guidance, released in November 2025, suggests a 3–4% total crypto allocation for qualified high net worth investors. Their core recommendation breaks down as 2–3% in Bitcoin ETFs and 1% in Ethereum ETFs, suitable for a balanced portfolio. For more aggressive clients, they allow up to 4–5%, which may include light staking yield or covered call strategies. This tiered approach recognizes that Bitcoin and Ethereum are not the same. Bitcoin is the primary store of value asset, while Ethereum offers a different risk-return profile. Third, implement through spot ETFs in tax-advantaged accounts whenever possible. For U.S. investors, spot Bitcoin ETFs like IBIT BlackRock and FBTC Fidelity offer regulated, insured exposure with no self-custody risk. Hold these in Roth IRAs or 401(n)s to avoid tax complications. For UK investors, note an important rule change. Crypto exchange-traded notes, ETNs, became eligible for stocks and shares ISAs in October 2025. However, from April 6, 2026, crypto ETNs will be reclassified and can only be held in innovative finance ISAs, a variant that few ISA managers offer. So if you want tax-free crypto exposure in the UK, you need to act carefully and consult a tax advisor. For Canadian investors, both Bitcoin and Ether ETFs are TFSA and RRSP eligible. Purpose Bitcoin ETF and Evolves Bitcoin ETF are popular options. Buying a crypto ETF inside a TFSA allows all gains to grow tax-free, which is a massive advantage over holding crypto directly in a taxable account. For Australian investors, crypto ETFs are available on the ASX, such as the VanEck Bitcoin ETF, VBTC, which is accessible through standard brokerage accounts. However, these are held in taxable accounts, so capital gains taxes will apply on disposal. Always check the specific product's eligibility for your account type. Fourth, rebalance religiously. Crypto is volatile. A 3% allocation can become 6% in a month if the price doubles, and a 6% allocation can become 1% if the price crashes. Set a quarterly rebalancing schedule. If crypto exceeds your target by 50% or more, sell back down to your target. If it drops below half your target, consider buying more, but only if you have the conviction. This discipline prevents you from falling in love with a winning position and riding it all the way back down. Fifth, and most important, never leverage. Do not trade on margin. Do not trade futures. Do not borrow to buy crypto. The single biggest predictor of catastrophic crypto losses is leverage. The 2025 crash wiped out traders who were over-leveraged, not long-term holders with small allocations. Be a holder, not a trader. The bottom line, treat crypto like a small satellite, not your main engine. Let me be blunt. Most people who ask, "How much crypto should I own?" are really asking, "What's the number that won't make me feel like an idiot if it goes to zero, but also won't make me feel like an idiot if it goes to the moon?" The answer is a percentage between 1% and 5%, depending on your age, net worth, and risk tolerance. For the vast majority of my viewers, the right number is 1 to 3%. If you have less than $50,000 in total investable assets, crypto should be no more than 1% of your portfolio. At that level, you can learn, participate, and get educated without jeopardizing your financial future. If you have a larger portfolio and a longer time horizon, 3 to 5% is the absolute maximum. Once you go beyond 5%, crypto stops being a satellite and starts driving your portfolio's risk profile. And as the data shows, the risk doesn't scale linearly, it accelerates. What about Ethereum? Ethereum's higher volatility, 98.3% annualized, and its technological uncertainty make it a riskier bet than Bitcoin. I recommend capping Ether at half your Bitcoin allocation. If you have 4% in crypto total, put 2-3% in Bitcoin and 1 to 2% in Ether. And for everything else, Solana, Cardano, Dogecoin, XRP, and the thousands of smaller coins, those are not investments. Those are lottery tickets. If you want to gamble, take 0.5% of your portfolio to the casino. Just know you're gambling. Here's your action plan for today. Step 1. Calculate your total investable assets. Be honest to Step 2. Decide on a target crypto allocation based on your time horizon and risk tolerance. Under 40 years old, up to 5% maximum. Over 40, under 2%. Within 10 years of retirement, consider 0%. Step 3. If you decide to allocate, implement exclusively through spot ETFs in tax-advantaged accounts when possible. In the US, use IBIT, BlackRock Bitcoin ETF in a Roth IRA. In Canada, use Purpose Bitcoin ETF, BTCC in a TFSA. In the UK, use a crypto ETN inside an ISA, but watch the 2026 reclassification rules. In Australia, use an ASX-listed crypto ETF in a standard brokerage account. Step 4. Set a rebalancing calendar. Every quarter, check your crypto percentage. If it's drifted more than 25% from target, rebalance. Step 5. Never, ever use leverage. Delete margin trading features from your account. Do not borrow to buy crypto. Step 6. Treat the rest of your portfolio, your index funds, your emergency fund, your retirement accounts, with the respect it deserves. Crypto is a satellite. The core is low-cost index funds. Let me leave you with a final thought. The people who made the most money in crypto are not the ones who bet the most. They are the ones who bet early and held. But early is gone. The days of 100x returns are behind us. Today, crypto is a volatile asset class with real diversification benefits at small allocations and real downside risks at large ones. You don't need to be a maximalist. You don't need to be a skeptic. You just need to be disciplined. Here's your challenge. Comment below with your target crypto allocation. I'm targeting 1%. I'm targeting 3%. Be honest. I'll reply to the first 50 comments with a personalized reality check. If this video gave you the data to make an informed decision, hit the like button. It helps others who are struggling with the same question. Subscribe and turn on notifications. In the next video, I'm going to expose the sneaky fees eating 40% of your 401n and show you how to switch to low-cost funds today. The difference between an investor and a gambler is not the asset, it's the allocation. Now you know how to be an investor. I'll see you in the next video.